So there are several reasons for a marked change in price. So one is where a whole group of companies get marked down together. So quality stocks on high PEs get sold down together. That's one situation. Or you get a one-off situation where one stock sells off quickly. So let me take the second one first. A stock we own sells off very quickly. The first thing we'll do is look at the underlying reason for it and see if there's more to it than just what's being reported. That is there an underlying problem with this business that we haven't picked up, that the market's picked up? That's rare, but it does happen. Or is it just that the whole market's gone sour on a particular sector at the moment? That is, when HealthScope got sold off, Ramsay got sold off, but they're different businesses. And so that often produces an opportunity for us. So I'll give you an example. A number of years, we'll all remember that Cochlear had a recall, their first recall ever, and the stock got heavily sold off. We immediately got on a plane, flew to the United States, talked to they call them audiologists over there, about their view of the future of Cochlear. They were upfront about us. They said they were disappointed, but they thought that the recall had been handled really well and that they hadn't changed their long-term view of the company. We came back, did our numbers, decided that there would be some change to the long-term market share of the company, but not nearly as bad as everybody was making out. We bought heavily. The market recovered over the next couple of years, and that's been one of our best performing stocks over those periods, with a larger holding than we otherwise would have had because the market presented us with an opportunity. So if we're talking about a rotation away from quality businesses, so businesses that have high margins, sustainable competitive advantages, very strong value propositions to customers, businesses that are growing their earnings over long periods of time, our estimate is it's usually 1 or 2 reporting seasons, not always the first. Sometimes the market is so focused on whatever theme it is, they just bypass that whole reporting season in spite of the fact that the numbers are good and they confirm long-term trends. But usually by about the second reporting season, the market finally takes notice of holding earnings growth. So during the GFC, that's exactly what happened to us. In the early stages of the GFC, the results weren't all that bad. I mean, there was a reduction in earnings growth that happened across the market, but by about the second or even the third earnings season, the companies we had already dipped and were coming back out of it. And of course, then the market recognised that. So in a year when the market was down 22%, our fund did 0% in that year. And that's largely on the back. We didn't hold much cash either. That was largely on the back of just delivering earnings growth during that period when most of the companies in the market were actually being slashed.
So it sounds to me what you're saying is these sorts of scenarios, over your experience in investing in growth stocks, you get a chance to have a look at the earnings and still time to buy stocks.
Correct. The market provides you with months. If you're patient and you take a long-term view, you don't need to make a decision on a day.